Good morning, everyone. Welcome. My name is Rashmikumar Shah, and I'm doing this webinar from Dallas. And thank you for joining on Saturday morning. I appreciate. Now the standard disclosure that this webinar is for our investors and residents of India who are living in India, and not for any people living in North America. Since I'm doing this from Dallas, I need to make that disclosure, and I'm going to talk more about how corporates are going to consolidate it in going forward, and what trends I see because of this COVID-19. Okay, and I'll be talking for about 25 minutes, and then I'll take your questions on the chat box. You can put that, and I also would like everyone to subscribe to our channel. At the end, you can, on the YouTube channel, there is a bell. Just click on that, so you'll get notifications for the future webinars. Yeah, thank you very much, and let's start now. So today's topic is what kind of consolidation we are going to see because of this COVID-19 havoc and all the changes which are happening in the world. So if you see into 2020 is a year none of us will ever forget. So the number one global issue today is about corona, correct? The corona is still not, COVID-19 has still not, coronavirus has still not picked up. The number of cases are going up day by day, and India, America, Brazil, all these big nations, Russia, still the top has not reached. So in the month of April, someone had predicted that US will be number one and India will be number two. I didn't believe that time. So I'm showing you the trend here, which is live, which shows you the number of cases corona is having. So on this right hand side corner, you see the date, correct? So here you see the date. So on February 6th, United States was here, China was here, India was here. India was here, correct? So that as the date progresses, you see how the number of cases, daily number of cases were going up. China, it plateaued in sometime in March. India crossed China in May, and see how the trend is going. And this today, America is number one, India is number two, and still nowhere we see signs of the trend plateauing, correct? So they say in India, it will take another 2 to 3 months for the cases to start declining, the daily new cases, and in India, and in America, it will take another 1.5 months. By end of November, they say 2 lakh people would have been died. It's very unfortunate in America. India, it's very difficult to make an estimate, but it will be a significant number of people. Now this, if you go on the internet and you can, these other curves, these are for different nations, but for today's webinar, I selected only US, China and India to show you the impact. China is already stopped, correct? Now India and US are still going up, and this is having a major impact on politics and also the businesses, everything, correct, in those two countries. The second most important event of 2020 is the global trade wars, the global issues. Now, corona is number one, and number two is that, now again I'll tell you, in 1950s, the World War I and II happened because of who controls oil, natural resources that time. When, automobile was discovered in 1900, everybody was fighting for oil. So oil was the major issue. In 2020, oil is no longer a major issue. So what is a major issue in 2020 is the data, internet. So 5G, correct? So every country is fighting for dominance in that, and the trade wars. So their physical wars are not going to take place like the one which we had on the borders of India and China. It got settled in 2 days. Both the parties took a step back, but the wars will be fought in the financial markets. So wars will be fought in the financial markets, and that's where India plays a very big role. See, when the wars were getting fought for natural resources, India's importance in the world stage was not much because India didn't have much oil. But in information technology, India plays a very big role. The data, the number of, so you will see that large FDI. So I'll talk later part of the presentation how this is going to impact India, and India is going to be one of the key players in what happens in next 20 years. Yeah, so these are the two major issues. Now, in 1896, there is one economist called Pareto, and he asked himself question. He was from Italy, and he was analyzing the economics of. So he says, why some people are so rich, and most of the people are so poor? Why some people, employees produce, they're so hardworking, others are not? Why wealth is concentrated in few families, and why few diseases contribute to the maximum death? So he says, what is the reason behind this? So when he started, he was a statistician and an economist. So he came with a principle called 80-20, and that's called as a Pareto Principle. So what that principle means is, and that's true in every aspect of life, it's 20% of items produce 80% of the results, in fact. So if you say, so this applies in investments also. So 20% of the companies in the stock market, they have a market cap of 80%. 20% of employees in any big corporation generate 80% of the revenue. You see that even if you do your customer analysis, in your simplicity also, 20% of our clients generate 80% of our income, and 80% of our clients generate 20% of the income. So this happens everywhere in every aspect of life. Now this is going to be more pronounced in the stock market and going forward. So why I have chosen this topic. In India, people are used to having too many investments and over diversification. So when you do over diversification, you'll get national returns, national average. So most of the people who are attending my events today, their personal income would be 10 times or 20 times the national average. The national average income, what is it? Per capita income in India is $1,800. But the people who are attending my webinar, minimum income will be $30,000-$40,000 per family, correct? So but that population is hardly less than 20, correct? So those 20%. Same thing is in stock market. So you need to focus on investments in companies, the 20% companies which are going to generate 80% of wealth, and that's why that Pareto principles become very important. And so which are those, how do you identify those 25% of the companies or sectors or industries? So I'm going to talk about that. But remember, 80-20 rule. So if you're a businessman, you look in your company, 20% of employees will be contributing 80% of your revenue. So I used to work for a Fortune 500 company in US. So when there was a 2800 crisis happened, I was sitting with the senior management executives, and so they were worried that if they are laying off 15% of the people, what will be the impact on the productivity of the company? I said, nothing, it will go up. Because 20%, you have to be only selective, non-performance you have to remove. Now, only 20% people contribute to the 90% of the income. In fact, efficiency will go up if you lay off 15%. So it's a very sad thing, but that is the reality of life. But that's how economics work, and that's the human mind works, correct? And the same thing is going to happen in stock market. I'll give you another example. If you take the natural resources of the world today, the developed economies, they are only 15% of the world population, but they control 80% of land area in the world. The developed economies are only, as I said, population is 15%, but they control 80% of the world economy, and 80% of the people, 85% of the people from emerging economies like India, South Africa, Asia, most of these South American countries, they form 85% of the world population, but they contribute only less than 20% of the world GDP. So the same thing is going to happen in the stock markets. So that's why when you are investing, you need to focus on those 20%, not on the 80%. So that's the key thing in investing that applies, correct? So if you look at your portfolios, anyone's portfolios, I'm talking about the total assets portfolios, 20% of your assets will generate 80% of your income. Now today, a lot of real estate, people have blocked 50% of their wealth in real estate, would be generating zero income, correct? Or negative income. Because for the last 5 years it has not been performing, next 5 years it's not going to perform. So your financial portfolio, on an average, I've seen Indian families have less than 10 or 15% financial assets. 80% assets are in real estate. Now, or physical assets, correct? They have physical assets and they're not income producing assets in this kind of environment. So 20% of your assets will generate 80% of your regular income. That's going to happen. 20% of your savings will contribute to 80% of wealth creation. Other 80% of your, this will go. 20% of stocks will contribute to the 80% of market cap of any country. Whether it's America or India, it doesn't matter. In America also, the top 5 stocks, Microsoft, Google, Apple, they contribute more than 25% of the America's market cap. So America has more than 5,000 listed companies, and they're all good companies, but of that 5,000, 100 companies or 150 companies, they contribute 80% of the market cap. Same thing is in India. 10 big companies, they contribute almost 60% of India's market cap. So this concentration is going to be more pronounced going forward because the smaller companies will struggle on economies of scale, struggle in debt, and that is going to be the issue. So this is a high level. So now I'm talking about, now I'll do a deep dive on the sectors and stocks which will do that, correct? So if you remember this slide, this slide is from my April 7th webinar, what's next when Corona happened. So that time I had predicted this, that eventually science will win and the world will get back to the normal. We expect few things to happen. Number one, the stock market rally will start from US. The US will start, no matter what happens, how many people die in America, but the rally will start from US. And if you see, that's what happened. And I was saying in March, April, it was a very good time to invest. There was a bloodbath on everywhere in this thing. Then I said a large number of small and mid-cap leverage businesses will go bankrupt. They have not yet gone, but they started going up. 80% of the airlines in the world are going to shut down. Now, so airlines is going to be, airfare tickets are going to triple up. A common man won't be able to travel like the way it was so cheap, airlines were so cheap, that is going to go. Airlines like in 1970s and 80s were very expensive. Same trend is going to happen now. There will be few airlines because most of the airlines will go bankrupt. Cloud computing and digital economy will lead the world. Okay, so before I come here, international tourism will take a backseat for next 2 years or 3 years. There will be more domestic tourism. So when domestic tourists spend less money than international tourism, so again, hotels, restaurants, the earning capacity is going to go down. Only this will survive. Now, most of the cloud and digital, most of the products will be sold on digital media. So those, after US markets, I said digital companies will rally. You must be seeing the information technology stocks have already gone up 30% in the last 2 months. And they are further going to go up. Now, any company which has no debt in this market, business, and it's number 1 or number 2 in its sector, they will do very well. They'll capture more business. That's what we said. And that's the same trend we see. Social distancing is going to be the norm for next, not 6 months, for next decade. Because this coronavirus is spread so widely, even if the vaccine has come out, it will take 3 years for the virus to go and to have a proof that virus is gone. So there will be always a fear, and that fear is going to drive social distancing as a normal way of life. Normal way of life. We'll be wearing masks for next 3 years. I don't think we'll have a choice. Work from home is going to be permanent for at least 2 years. So this is going to drive the behaviors of a lot of assets and a lot of companies. So if work from home is going to be permanent, so I was talking to one US executive Last 3 months, last 1 month, I've been telling everyone in India that IT companies, Indian IT companies will do very well. So they said, no, Trump is going against H1. I said, don't worry about that. Why IT companies will do well? So I was talking to one Indian IT companies will do well. I was talking to one US executive. So I asked him, how's your company doing in work from home? He says, everybody's work from home and we have made it as a permanent feature. So I said, now we are coming back to office optional and we are downsizing our office space. They had 2 lakh square feet. They are reducing it to 1 lakh first and then 50,000 square feet. So I said, which employees are getting preference? He says, Rashmi, you know what the funny part is? The clerical jobs, accounts payables, account receivables, accounting, customer service, those people, they didn't have laptops and they used to still work, a lot of paperwork and manual work was there. So we had to ask them to come to office for running our company. Now, in last 2 months, we have made everyone of those employees to work from home. Then we realized if these people can work from home, administrative jobs, clerical jobs, why we want American employees? We shift all that work to India. So that was an eye-opener. And he asked me, do you know any companies who will take over our work? I said, I am not from IT field and I don't recommend this kind of stuff. There are a lot of other agencies, please go there. So what happened is, I saw that trend and that's why Indian IT companies are going to do very well. Then there is a massive shift going to happen in asset allocations. So still people have investing in, 90% people in India want guaranteed and fixed return. So, and they want to see the assets. They like to touch their properties. They feel they get good sleep when they see the real estate. But now they have, for 5 years, they got a pain. Now the real estate is not giving the income. So they will liquidate that. Now same thing happened in bank fixed deposits. As interest rates goes down, people started taking extreme risk in fixed deposits and debt funds. And for getting 1% higher, they started investing in those kind of, all that money is going to come to stock market. So that also is going to change. That behavior is going to change in next, and it will take 2-3 years. People don't change. People change only when they get hurt, as we know that. Now, so 2 days back, I go for a walk every day in the morning with a friend here. So I said, funny part is, as the number of coronavirus cases are going up, so is the stock market. So he says, when the stock market will go down? I said, it will go down when coronavirus cases will start falling down. I said, why? He says, why is that? I said, as the cases are going up, people think market is going to fall. So they are selling and they are not investing. Retail public thinks that way. Watching television, hearing, talking to the friends. Sitting at home, people don't have much, so they look on their financials and they want to do something, correct? So they're all selling just now. They're thinking, let's book profit. I said, market is not going to come down. Then when the cases start dropping down, they think now market will go up. And they all will think, let's go and invest. And then the market will start coming down. And that's going to happen. So I'll give you another data point here. I will share that with you. So yeah, and this is the data from 1st Jan till today, correct? So I'm comparing Nifty, Nasdaq, S&P 500, Dow Jones, and Nikkei here. So this is January, this was the index. February 15th was the peak, correct? The markets were at the peak. March 20th, the markets were at the 52-week high. And 17th July, this is the market. So if you see the Indian stock market from 52-week high, it came down by minus 38% in the month of March. But currently today, the market is at only minus 12% from 52-week high. So it has recovered 26%. And from 52-week low, the market has gone up 43%. So people think market is very high, it will come down. But if you compare this from January 1st, the market is still down 11%. The Nifty and is 11% down. But Nasdaq has gone up compared to that and has given 24% return. So US market has given 34% higher return than the Indian market. The gap between the US and India from January 1st is minus 34. So India has underperformed by 34% even today. Compared to S&P 500, India has performed minus 15. Compared to Dow Jones, minus 15%. And compared to Japan, also minus 15. So India has a lot of catching up to do. And I foresee that catching up will happening in next 2-3 months. Eventually, India will be at par with US. The US ran first. That doesn't mean that you have to exit US. What I'm trying to say is now the speed of market going up in US will be slower. The speed of markets going up in emerging economies like India will be higher. Why? I'm going to talk about that. So that speed. So even if you feel the market is high today, it is not at its peak. The peak will come in the month of September, October. So market can go up 20% from here and then correct 10%. But it's still going to be 10% higher than today, correct? So that's what I'm trying to say. So Indian markets are underperforming the US and Japan. Now I'm going to share some data with you. So what I did, how the consolidation is going to take place in the Indian stock market. So I took the mutual fund data. This data is as of 30th June. Now the total mutual fund, I have converted this into this is the Indian, this data I have taken from MFI website. 25,48,000 crores are in mutual fund. But if I convert into dollars, it's only 340 billion. 340 billion. As against 340 billion of Indian mutual fund, the US is 20 trillion. The US mutual fund industry, which including ETF and mutual fund, is 22, I think it's $22 trillion. India is only 340. Now, this is going to go up drastically in next few years. But of this, if you notice, what I'm trying to say is 80-20. Of this 340 billion, today hardly 10% of mutual funds are performing, or less than 10%. Now, so how do you identify them? So I'm going to share that data also. Of this 340 billion, index fund is only 1 billion. Equity funds are 131 billion. Debt funds are 173, correct? Now, of that, the sectorial funds like pharma fund, technology fund, US fund, their ratio is only 0.04. So these funds, which are leading and moving way ahead than the average funds, is only 0.4%. Not even 1%. So 99% people have not invested in these funds. They have invested in this. So let me share that data with you. The next slide I'll go. Now, I have taken the top 20 mutual fund schemes of India, and this is the NAV which was on 1st Jan, and this is NAV as of July 16. Now, if you see none of those top 10 funds which contribute to 20% of the AUM of the Indian stock market, they are performing. They are all -8, -2, -16, -17% returns. Now, these are mostly large cap and not small cap or mid. There is one mid cap, HDFC mid cap on a few of them. But if you look at the pharma, technology, US technology, ICICI US equity, Franklin India, Nippon, they have given 29%, 14%, 24%, 9%. So they have. Now, how much is the investments done by Indian public here? Less than 0.4%. Now, at simplicity, this is more than 60% of our portfolio. Why? Because we focused on sectorial, and we are specialists in that. We are one of the few. Now, I don't believe in investing the national average, what everybody's chasing, what comes. See what happens where retail investors are investing. I avoid that sectors because then I'm going to get a national average return. National GDP is $1,800. I don't want a national return. I want a higher return. Now, so this is the where we are focused. So now when eventually all these funds which are giving negative returns are going to be positive. So when this becomes 12%, these funds will become giving you 50% return. They'll be way ahead. That's what I'm trying to tell you. So in mutual fund industry or in stocks also, the stocks which are performing today, they are going to be way higher than what they are today. Because that 20% performance, that 20% of the market in mutual funds on equity are going to be 80% of the market cap of India, and that's where you're going to be seeing that trend. Now this is the chart. I don't have this data for India, so this is the chart I took out from the US, one of the US websites. So last 40 years trend between large cap and mid cap and small cap. So what there's large cap divided by small and mid cap, correct? The performance wise. So if the ratio is less than 1, so if it's 1, means large cap and mid cap both are performing the same. But if it's more than 1, that means large cap is outperforming. Less than 1, small cap and mid cap are underperforming. Now, if you see in last 30 years, only 2 times, in 1992 and in 99, when Y2K boom was there, that dot-com bubble was there, correct? The dot-com bubble came. That time, the small cap performed better than large cap. Otherwise, always the large cap have performed. Now, this trend is going to be more pronounced in the coming 2-3 years. There is going to be more this kind of separations. It's not going to happen overnight. It's going to happen gradually. Now, some of the mid caps companies will become large cap. I'm not disagreeing that, but there will be very few. There will be very few, and you can count them on your fingers. But majority of the small cap and mid cap are going to go in a consolidation phase, and this trend is going to be more acute and more sharp than what it has happened in the past. What happened in the past 5 years, that trend is going to the trend was already there. Now it's going to be doing even faster because of coronavirus. Differentiation is going to be faster. Now here I'm comparing, this data is for, I don't have an Indian stock market, this is of the US stock market. Compared to since 1990, gold, Nasdaq, Dow Jones and silver. So if you are invested 100 rupees here, gold and silver would have become 250 rupees, gold would have become 300 rupees, and Dow Jones would have become 750 on Nasdaq. So long-term outperformance of the stock market is going to continue. Somewhere in middle, gold will outperform in phases, correct? But if you take a really long-term period, all equity markets will always outperform the gold and silver market. Now, the other thing, so how do you identify the sectors where so here's a chart of competitiveness chart I've done between India and Mexico. So this kind of analysis all these companies they do when they want to move business to India. Should I move to Mexico or should I move to India? So there are 12 parameters, correct? So if the blue line is India, the green line is Mexico. Now, if you see the first institutional wise, the first pillar, Mexico institutions are better than India. Infrastructure wise, Mexico is way ahead than India. But macroeconomic environment, Mexico is better. But fourth, healthcare and primary education, India has a better than healthcare and primary education system than Mexico. Now, the sixth pillar is labor market efficiency. Both are at same, correct? The labor is very cheap there. Where India is 11th, where it pronounces business sophistication. Indian companies are very sophisticated. Indian financial market is very sophisticated. Stock market is very sophisticated. Banks are very sophisticated compared to Mexico. So this kind of analysis they do. Now you have to do the same kind of analysis when you're investing in stocks or mutual fund on these parameters. The quality of management, the quality of these portfolios, and the sectorial. So this is one of the way to look at it. Now coming back to next phase of consolidation, where consolidation is going to happen. So I'm again saying healthcare and information technology, both these funds have performed very well. You know what shocked me is we invest in Franklin India Technology Fund. That Franklin India Technology Fund had come in 1996. The total AUM of that fund is only 250 crores. Simplicity started promoting this fund since 2016. We have almost 15 crores in that fund. So that fund has only 250 crores from India, of a new company like us, advisors, we came in 2016, we have put 15 crores. So hardly anybody is investing. So people are not investing in this kind of quality products. They are investing, God knows where, all general funds, correct? They are all experimenting. But this, so I said this fund is going to continue to outperform, way outperform. Even the pharma fund is going to way outperform, because what is going to happen? People are going to be extremely cautious of their health for next 5 years. The US companies, now because of this global war between China and US, mistrust, American companies don't trust China now, because they said China took that technology, copied it, and now dictating them also. So they fell very, I mean, especially in the technology market, IT, they are really fearful of China. They don't want to work with China in technology sectors. So they are coming to India. Same case is going to happen with pharma companies. Indian companies have never cheated in IT or in technology wise, like the way China has done. So the trust for with Indian as a country within US and in Europe has gone up. So we are going to see a lot of FDIs coming there. So this sectors, healthcare sectors, for pharma industries, more and more work is going to come to India. IT, more and more work is going to come to India. So these companies are already cash rich. They don't require loans. The capital requirement is very less compared to infrastructure and all that. So this sector will continue, though they are defensive sector, but they will continue to outperform. So what I'm saying, this 20% of the sectors will give you 80% of the returns. So these are some of the sectors. Then cloud computing, digital, telecommunication stocks, Reliance, Bharti Airtel and Vodafone, they are the only three companies left. They all will outperform. IT and cash-rich companies, and India is going to get, you see, today the India's FDI, foreign currency reserve is $510 billion. It is the fourth or fifth largest in the world. The US foreign currency reserve is $250 billion. US is only $250 billion. India has $510 billion. Now, we are going to get massive FDI investments. So there's going to be massive fund flows are going to come to India. The liquidity is going to improve. But everyone is not going to benefit. It's only the companies with good management, good business plans, they are going to benefit. And that, so the trend, the valuation will be very skewed, correct? If a company is very good, like Asian Paints, and there is another chemical company, if the management is not good, their stock will not go above 25, but Asian Paint is 2000, correct? 1800. So you will see this kind of, now you take Avenue Supermart and Future Group, correct? Future Group was way ahead in retail business compared to Avenue Supermart, but they never got that valuation because the management trust was not there. But Avenue Supermart, see the way the stock price is, correct? So everywhere the money is going to flow to the best and most ethical management and the number one leader. That's going to happen. So you need to focus on those kind of stuffs, and you will see massive mergers of all these small companies who won't be able to sustain, and they'll have to sell off, correct? So that phase of consolidation is going to come. The sectors which are outperforming now, they'll continue to outperform. That's what I'm trying to say. Now the biggest problem we face today is the behavioral analysis. Because last 5 years Indian stock market didn't perform that much. The US market performed. So a lot of pain we went through. The Indian investor has gone through a lot of pain in the last 5 years, and he has not seen a decent return. So now as the markets are rallying, most people want to book profit and get out. So I see that's the challenge. So controlling the behavior of the client is going to be the key factor. Controlling your emotions are going to be very, very strong, and which we need to focus on. So this, the reason I showed this slide, so I have already done this on behavioral analysis webinar, which is on my YouTube channel. I would like everyone to watch this once in 6 months, and so they know what mistakes they make and how their emotions drive. So most of the times we have seen, after watching television and the stock price or the NAVs and what comes on, people get emotionally decision making that's happened. Now, as I said, the FDI is going to come. The largest FDI had come in the telecom sector in last 15 years. One company, in next, even more FDI is going to come in the telecom sector, as we are seeing just now in Reliance. Now you will see also in Airtel, Vodafone, more FDI is going to come. You'll also see more FDI coming in banking sector. You'll see telecommunications, service sectors, automobiles. Why I'm saying automobiles? Automobiles is going through, automobiles as a sector is going to remain, and it's going, people mobility is very important. People will fly less, but they'll drive more worldwide. So automobile sector will do well. But within the automobile sector, the technology companies, the companies like who are electric cars, who are modernizing, they will do well. So my last webinar was on that. You can go on a YouTube and see that. So you'll get a lot of FDI here, and India is good in automobiles. So these sectors are going to do very well. Construction sector, India will get less FDI. They'll get massive FDI for building infrastructure. Healthcare sector also will get a lot. So you'll see Apple is shifting its one of the factories more in India again, correct? So when those kind of, IKEA is building more outsourcing from India. So as those companies bring more and more manufacturing to India from China, what is going to happen is you will see today our FDI is average $70 billion a year. You may see 200 billion, 300 billion FDI coming to India. When that kind of money comes, you will see the Indian stock market, what will happen. So India was the 9th largest FDI in 2019. From 9th, I expect it to come down to 4th or 5th in next few years. So when that happens, massive fund flow is going to come. Now, India lacks on innovation. It's on 52, yeah, correct? So here it has to improve. But a lot of money is going to come to India. And this is going to drive the Indian stock market and Indian capital market, because interest rates pressure is going to be there everywhere in the world. So India can't afford to increase the interest rate. So all retiree population in India and those who are used to fixed income, they will panic. They're already panicking, which we see now, and they won't know how to invest. Same trend happened in US in last 10 years. In US, the interest rates are only 0.5%, correct? Now, so that trend we'll see the massive shift happening. The 5 countries that India currently, which is very good in terms is US, Japan, Germany, France, and Italy. The money is coming from there. Australia, all those European countries will rely more and more on India than on China. That trend we are going to see. Now, if you take any of the portfolios of the big FFIs from US, and they don't buy more than 3 or 4 stocks in their portfolios. So if they have to buy only 3 stocks, I've seen 2 stocks common, HDFC and Reliance, common across the board, which I don't see in Indian mutual funds that heavily. I don't know why. So even ICICI is the 3rd stock which is very popular, and now Tata Motors is gaining popularity because of the valuation and this. Tata Motors has got 2 very good brands which are on the top trend brands in the world, Jaguar and Land Rover. They are doing well in overseas market. Tata Motors, I'm not saying because Tata Motors is India business, I'm talking about Tata Motors global business. So this companies, they are going to create more wealth in next few years. Now this is the my I think second last slide, then I'll take the question and answers. Now this is the data which I got from Morningstar recently, and it was very fascinating and interesting. I'll show you a pattern here. So there are 5 asset classes: India equity, debt market, cash market. So if you're putting savings account or cash, gold, and US equity. So from each year, 1990, which asset class performed the best? So in 1990, if you see in this chart, India performed the best. That gave 34% return. That gave 9 cash. US performed 1. So if you go through all these phases, you will notice in 2002, gold gave 24% return. Then 2008, gold gave 31% return. 2010, 24% return. 2011, 24% return. And 2020, 24% return. And when gold gave highest return, the US, in most of those years, the US underperformed the worst. So if you see that gold year gave year, the India and US are bottom year. Gold very good, so India and US are down here. But what happens on the year after gold gave better return? Every year India is the best performing market. So in 2002 gold gave 24% return. Next year Indian equity gave 98% return. 2008 gold gave 31% return. Next year India gave 88% return. Then 10 and 11 gold gave good return. 2012 India gave 31% return. This year gold has given the best performing asset class. Indian equity is the worst asset performing class. You see what happens next year, the probability. So this is a fascinating data I see. So if you look at this chart, I analyzed it. This is the macro trend. So if you get this macro trends right, your performance becomes very good. So I have to do that to identify that. So what I notice here, so if I take Indian equity, if we give the highest return in the year that followed by the best year of the gold. So gold performed best out of 30 years. Best performing was 5 times, worst performing 8 times. So net was only 3 times negative, correct? The highest yearly return was 31%, the lowest was minus 20. 30 years average return is 11% gold, which is a good return. 11% return is a very good return on 30-year basis. US equity was outperforming 6 years, worst was 3 years, so net. Indian equity out of 30 years, 50% time, Indian equity performed the best. Worst 9 times. And the best year it gave 98% return, the worst year it gave. So of all this asset class, what I'm trying to show you is that Indian equity gives the highest return, but is the most volatile. See, plus 98 to minus 57. You don't see that in US equity. You don't see in any other asset class, correct? So Indian equity market now, unfortunately, last 5 years, Indian equity, if you take last 10 years, correct? Let me go back to the back slide here again. If you take last 10 years, Indian equity has never given return more than 40%. But in the previous decade, they had 98, 63, 82, those 88 in 2009, those kind of returns you have not seen in the last 10 years. Indian equity has not done very well, and the US equity has performed very well in the last few years. Now, going forward, I see again Indian equity outperformance coming back. But you need to have US equity also in your portfolio because it's the least volatile investment. It's less volatile than gold also, if you consistently invest. So you need to have US equity in your portfolio. Hardly 0.20% of India's population is investing. At Simplicity, we make it 15% of our portfolio for all our clients, which is now we are increasing to 20%. With this, I end my today's event. Now, my next event will be legacy planning and investments issues during the uncertain times. That will be 2 weeks from today. Now, I will take questions from you all. So 1 second, let me start. And I have one request for everyone. If you liked our webinars and you want to see the future, please subscribe to our YouTube channel. The more subscription we get and the more people watch, we can invest more on this. So then we can further invest in technology and share more data and more insights with you, which motivates us. Okay, so the first question I'm taking, the question 1 is, once you identify a script for investments, do you wait for realistic price level or start buying in phases? Okay, very good. Very good question. Very good. So whether it's an investment in stock or mutual fund, to get the perfect timing is very difficult, correct? And so any investments we do, we do with 3 to 5 years horizon. We don't do any investments for buy today and next 6 months. We don't chase returns because you make more mistakes by doing that. So when we do any investments, we always prepare that, okay, our timing may be wrong. So if it goes down, we should be prepared to invest again. So we ask the client, if he's not ready to invest again, then we give him the safest investment, correct? If it's a one-time investment, we don't like that. We want in phases, and we buy in phases, and we build the portfolio, correct? We build the portfolio. So let's say you want to buy FMCG sector. So let's say Hindustan Lever and Nestle. So Hindustan Lever is 2,000 and Nestle is 16,000. I'll buy today. If it goes down 10% or goes up 10%, at both the levels I'll buy again. And that's how I build the portfolio. Yeah. The next question is, which Indian IT companies will do well, and which mutual fund we are really subscribed cover this opportunity? Okay. So one of the best IT mutual fund company is Franklin India Technology Fund. Since in any technology or knowledge-based industry, I avoid buying stocks. I prefer to buy a mutual fund because you get a basket, and they know better than us. Now, the best companies in IT again are Infosys, TCS, HCL, and all those. I would prefer Franklin India Technology Fund. We buy. We have a very large exposure in that fund, and we invest through SIPs and STPs. Now the third question is, gold is currently showing a steep uptrend. How long do you think this will continue, or do you think gold will slow down? Okay, very good question again. Just now, gold is the flavor of the season, correct? Everybody talks of gold, and Indians love gold. Indian spouses, if you buy gold, they feel very good, happy, correct? So it's a win-win situation. You get return, and spouse is also happy. So it's a good investment from that perspective. But gold will perform better. Gold has already factored in that the US currency is going to be weak in next 2 years' time because interest rates are not going to go. So that has already been factored in. Now, if US currency becomes extremely weak, then gold will outperform more. So we'll come to know about this after the elections. There are elections in US, and what policies the US government comes, because US government has pumped in a lot of money this year, and they need to recover that. They need to make their balance sheet stronger again. So what kind of tax structure comes, and what kind of currency policies they come, you will see that in October, November. I would recommend don't buy bulk gold, but buy maximum 5% in your portfolio should be gold, and you can buy that through STPs and SIPs. You buy ETFs, correct? There are very good ETFs available in the market. You can build that. Gold also doesn't move very fast, so it's a boring investment. You will find it, and then what happens is one day you will suddenly sell off. It's not like a momentum like stock markets. So the best way to invest in gold is through SIPs and STPs over a longer period of time, and not more than 5 to 6% of your portfolio. It's a doomsday scenario. In the doomsday, gold performs the best, but I don't think the doomsday we are going to see. But we need to have a little bit hedge, correct? So there's nothing wrong in that. So the next question is, I'm sure the Pareto Principle in the investment world is dynamic. Could we locate 20% top gainers in today's condition, reshuffle our portfolio, or move 80% of it to 20? Okay, so today's top 20%, of that top 20%, 18% will remain in top for next 20 years. It doesn't change so fast. So Hindustan Lever, Reliance, TCS, Infosys, those Infosys has been the top for last 25 years. Since 1995, it's the best performing stock, correct? 1 or 2 years. Only the sectors. Okay, so which are the sectors in India? Instead of stocks, you need to identify sectors first and then stocks, because the best stock in the worst sector will give you less return than the worst stock in the best sector. So today, if you are investing in IT and you invest in a worst stock, that worst stock will give you higher return than the worst sector. So infrastructure sector was the worst sector, or metal sector was worst for last 2 years. So your best company in that metal sector was Tata Steel. That stock will underperform even the IT stock, the worst IT stock in or pharma stock, correct? So that's what I'm trying to say. So for identifying the sector is more important than the stock. If your sector allocation is wrong, and that's where we are specialists. I think sector-wise, the Simplicity has taken a call that we don't want any sector where that debt is there. Any huge capital is required. That sector will keep on underperforming because there is going to be deflation. There is going to be deflation with so much money. The pricing power of the companies to increase the price is going to go down. So when pricing power is down, leverage businesses are not going to do well, and economies of scale only company and debt-free companies do well, correct? So again, FMCG, pharma, IT, consumer durables, they are going to do very well. Which sectors of companies which are cash rich and debt free today will not be existing tomorrow because of the change in trends? Again, good questions. Which sectors of companies? Okay, so today you take sectors of companies in IT. A new IT company has to take a debt, correct? So it's very difficult for them. But an existing IT company which is cash rich like Infosys, TCS, I don't think they will ever require debt. There will be very few. This is a tough question to answer, correct? Debt free today will not be. Telecommunication, which is heavily debt today, may not require that much debt going forward if the pricing is allowed. Because in India, the telecommunication is the lowest AGR, correct? Whatever we pay for our mobile phones is the cheapest in the world. If that price becomes higher, and which is going to be higher as more and more work from home, demand for internet. So as they accumulate, and what experience Vodafone, this Airtel and all other companies had, they will try to be debt free. So that is going to happen. So that is a sector which I think will become debt free over a period of time. Then what's your take on Reliance and with Jio platform and Jio? Reliance. Okay, so Reliance is there is a lot of politics also behind Reliance. So what has happened is, with the China dominance, all these Western countries are really shaken up, and India is a big market in telecommunication, and they don't want Indian market to go in Chinese hand. So all these companies, they said, okay, we went to government of India and they said, okay, we'll invest in Indian technology companies, telecommunication companies, and help, but we don't want them to go to China way. So that's why Jio is getting a lot of money, and they identified Reliance. Reliance is the answer to Alibaba or Huawei, because India doesn't have any semiconductor industries or chips manufacturing and all. So we are going to see a lot of things, and Reliance is one of the powerful companies, politically also very powerful compared to Vodafone or Airtel. They know how to manage the babus. So they are benefiting of that, correct? They are getting a premium for that. And Reliance also is, Reliance, you should have a proper weight in your portfolio. It will move with the market, and it will do reasonably well. I don't see much downside there. So next question is, which new normal, working from home and remotely reduced visits, will see reduce in operation costs? And okay, the question is, with new normal, working from home and remotely reduced visit, we see reduced operation costs. Do you think this will help more to small businesses compared to big one? Very good question. It will help only if the small business is tax savvy. If the small business knows, India has disproportionately large number of small businesses. Okay, so I'll give you, India's GDP is 2.5 or 2.3 trillion dollars. America's GDP is 22 trillion dollars. Now in America, there are $22 trillion. GDP is there, but there are only 19,000 on 1,90,000 small and medium enterprises in America. In India, there are 66 lakhs in $3 trillion. 66 lakh small and businesses are there, SMEs are there. You don't and for a pie. So disproportionately small businesses are there. There is going to be a lot of pain there. So there will be a consolidation there, and the small businesses which are tech savvy will do. Small businesses which don't want to take digital payment, don't want to give receipt, don't want to customer service or focus wise, they are not going to do well. So the next question is, okay, and work from home also, telecommunication stocks, a lot of FMCG stocks will do well, because when you work from home, you buy better quality of groceries, you buy better quality of food than eating in restaurant. So your expenditure changes more towards FMCG, correct? And you stock more items at home. Also use more internet. So those companies will do benefit. Streaming services will benefit. Do you think FMCG will always stay relevant along with pharma and IT due to be necessary? I would say not only because of being necessity, also because of now, as we buy more and more online, branding will become more important. So FMCGs, when you buy online, you buy more brands than you buy from a kirana shop, correct? So as more and more work from home and more conscious will happen, FMCG companies will do better, branded companies will do better. And yes, and as I said, we'll stock more items. So in US also, FMCG companies are doing much better this year than the previous years. And with this, I end my today's webinar. And thank you for attending it. And if you like the event, please subscribe to our channel. And thank you very much. And take care. Thank you.